90% of retail traders lose money, not because they are stupid, not because they are undisciplined, but because they are the liquidity. The breakout you just traded was not real. It was engineered. The market did not trap you by accident. It hunted you. Look at any chart long enough, and you will notice something deeply disturbing. The market almost always moves exactly where retail traders place their stop losses. You are staring at the screen. The price is approaching a major resistance level. You have drawn your diagonal lines perfectly. The moving averages are aligning. Everything in your textbook tells you to blindly buy. The breakout finally happens. A massive surge in momentum pierces the line. Driven entirely by the fear of missing out, you execute a market buy order. You feel like an absolute trading genius today. And then, the reversal begins. It is not a slow pullback. It is fast. It is aggressive, unforgiving. Your stop loss is violently hit. The green candle is immediately engulfed by a massive red block. As if to completely mock your existence, the price consolidates and continues in your original direction without you on board. You feel targeted. You feel like someone is watching your exact position right now. Everything you learned about trading was intentionally designed to make you the perfect victim. The market is not a random environment driven by retail hopes. It is a highly efficient, emotionless wealth extraction machine. You rely on indicators like the relative strength index or moving average convergence divergence. You believe these tools give you a predictive edge. In reality, they are merely delayed mathematical derivatives of past price action. These indicators do not predict the future. They simply package historical data into neat, colorful lines to give you a false sense of absolute security. They encourage you to place your capital at maximum risk. Understand the true mechanics of size. If you buy one standard lot, you are filled instantly. You are a microscopic drop in the ocean. But massive financial institutions face a very severe daily execution problem. Move $50 million without crashing the asset price. They desperately need a concentrated pool of instant guaranteed buyers. They need opposing orders. Where do they find this massive pool of instant market liquidity? Right above old highs, right below old lows, right where you place your hopeful breakout orders. When you buy an asset, your stop loss is a dormant sell order waiting to be perfectly mathematically triggered. It is guaranteed institutional liquidity. Institutions do not need to guess where these massive pools of orders are resting. The algorithms map out these zones of concentrated stop losses with ruthless, terrifying, and absolute precision. While you look at a flat two-dimensional chart, institutional algorithms visualize a three-dimensional landscape of resting orders. They see exactly where the pain threshold of the retail majority is concentrated. They target that specific pain. This is the liquidity sweep. Smart money will intentionally spend heavy capital to push the price just past a critical key level. They want the chart to look incredibly bullish to the untrained retail eye. The breakout is not the real move. The breakout is the bait. The moment the price violently crosses that resistance line, the trap is finally sprung. A predictable flood of retail orders hits blindly today. At that exact microsecond, the institution executes their true hidden intention. They absorb all of that frantic retail buying pressure to fill their massive short position. You are buying the grand illusion from the algorithm. Trading is an exercise in extreme psychological asymmetry. You are sitting at home, sweating over a 1-minute chart. Your heart rate spikes violently with every tick. Emotions are your ultimate vulnerability in this financial arena. On the other side of your screen is a cold server rack in a financial data center. It is executing a predetermined mathematical extraction function. Fear and greed are their primary and most highly effective weapons. The algorithm does not feel fatigue. It does not feel the fear of missing out. It does not hesitate when the parameters are perfectly met. It simply executes the protocol and silently extracts the capital. The amateur sees a breakout and feels sudden excitement. The professional sees a breakout and feels absolutely nothing. They wait quietly in the shadows. They know 90% of breakouts will violently reverse straight downwards. Financial media and trading gurus feed you a completely toxic narrative. They tell you to look for retail chart patterns, wedges, and bull flags. These are the exact historical blueprints used to engineer your downfall. To break this cycle of continuous financial losses, you must accept the uncomfortable truth. You are playing chess against a supercomputer that knows your next 3 moves perfectly well. You must fundamentally reprogram your mind. Retail traders blow accounts because they cannot accept being wrong. They move their stop losses further away. They average down into losing positions. They transform a small tactical error into a completely devastating financial catastrophe. Algorithms do not have any ego. If a setup is invalidated, the system cuts the loss within a millisecond. There is no hope, no bargaining, and no revenge trading. It is just cold, binary mathematical logic. You must adopt this exact machine-like characteristic. When you execute the aftermath protocol, you must detach your self-worth from the outcome of a single trade. A loss is just a business expense, nothing more. How do you stop being the liquidity and start trading alongside the smart money? You must adopt a ruthlessly stoic mindset. You must discard the retail playbook entirely. Rule number 1 is incredibly simple today. Never chase the breakout. Ever. When a key level is broken with aggressive momentum, your default emotional response must be deep, calculating suspicion. Let the frantic amateurs blindly provide the necessary liquidity for institutional algorithms. Rule number 2 is wait for the liquidity sweep to be confirmed. You are looking for a specific algorithmic footprint. You want to see the price pierce a major level and violently reject straight downwards. That immediate, aggressive rejection is the smart money leaving their undeniable fingerprint on the chart. It means the retail liquidity has been fully absorbed. The true institutional direction is finally about to reveal itself clearly. You must wait for the candle to close firmly back inside the structural range. This close is your definitive mathematical trigger to take lethal action in the market without any hesitation or emotional fear whatsoever. Rule number 3 is enter the aftermath. When the sweep is confirmed, your mindset shifts from silent observer to cold executor. You do not predict future moves. You aggressively react strictly to the hard data. You enter the market in the direction of the violent rejection. Your hard stop loss goes safely above the newly created algorithmic sweep wick. Your targets are the opposing liquidity pools at the absolute bottom. Once you are in the trade, the psychological warfare continues. The market will attempt to shake you out. It will consolidate. It will retrace. You must remain completely detached from the fluctuating, unrealized profit numbers. You are no longer providing liquidity to the market makers. You are riding the silent institutional wake. This execution protocol requires absolute, unwavering discipline. It requires sitting completely still while the market is entirely frantic. It requires watching fake, manipulated moves run away without you. But we do not trade for momentary excitement. We trade for extraction. We trade to protect and systematically grow capital in a deeply hostile environment. Discipline is not a temporary state of mind. It is a permanent behavioral adaptation to an environment designed to destroy the weak. You must build an impenetrable psychological fortress around your executing capital daily. The market does not know you exist. It does not care about your hopes or your financial dreams. It is an emotionless mechanism of capital transfer. It moves money seamlessly from the extremely impatient retail traders. It transfers wealth from the highly emotional to the deeply stoic. But it will gladly take your money every single day if you continue to behave exactly like the blind, predictable retail trading emotional crowd. Strip away your emotions. Erase the diagonal lines. Stop fighting the algorithm. Understand the true, hidden mechanics of liquidity. Do not chase the trap. Wait for the sweep. Execute the aftermath. Stay entirely ruthlessly cold. Stay completely and utterly disciplined. Because the brutal truth is this: The very next aggressive breakout you see on your charts tomorrow morning will probably be just another mathematically engineered trap waiting patiently for you.